Okay, I think that we've had a little bit of a reprieve. I mean, I still think that yields are going to be low as long as the market expects the Fed to not hike interest rates. I know the Fed's telling us they will. Nobody believes that they will. The market has cuts priced in over the next year or so. I don't necessarily believe that either. However,
what do you believe?
Well, effectively, I think the Fed's going to be on hold indefinitely, and indefinitely, and that the bar for a rate hike is a lot higher than the bar for a rate cut. So, in other words, it's easier.
We're going to get a cut, though. Some people are already saying 50
it's easier. It's easier to get a cut than it is to get a hike right now. So, if you think of the 10-year yield as really being a creature of the short-term rate rolled over, the overnight rate rolled over every day for 10 years, that path of rates is down. That's going to weigh on the back end of the curve. And look, we're in a range, I think, in the 10-year note, 2.25% to 2.75%. I don't think there's anything wrong with that.
Okay. If he's right, you may have a problem, sir, on the equity side.
Yeah, I think what he's saying is the Fed is on hold and dovish. We've taken that downside risk of the Fed continuing to hike amid a slowing economy. And in our view, a stabilization in growth is priced. A turn up in growth with the Fed staying on hold is not. So we still think we have some room to run.
So you think the market is completely priced for? We already saw retail sales are down. We have an expectation that corporates, on at least on a comp basis for the rest of the year, are going to be lower than they were last. You think that's totally priced in the market where it is?
I think the stabilization in the slowdown in growth is priced in, meaning we overshot in the fourth quarter. We've come back up. But to your point, we're in the midst of an earnings recession where we have 2 quarters in a row of quarter-over-quarter declines in earnings. And so I think to the extent that earnings resume that glide up, that equities can follow.
Okay. In terms of equities, we also seem to have this enthusiasm / maybe lack of enthusiasm, depending on what you think of what happened to this Lyft IPO. What does the IPO market say to you in terms of where equities may or may not go, in terms of where the retail? I mean, there was a view this spring, I heard it from a lot of hedge fund managers, there was a view that there was going to be a lot of inflows from the retail investor, both into IPOs, but then it was going to extend out, and that actually might push up at least multiples, if not prices.
Yeah, I think to the point about IPOs, they usually come when you have big inflows and retail participation. What have we had year to date thus far through this rally in terms of global equity inflows? 80 billion of outflows.
Right.
So we haven't
what's going on here?
So I think you've seen investors that were underweight risk are coming back in. Retail is waiting, and you have buybacks and corporate buying that have been supportive.
Hold on one second now. Okay, earnings recession. What did you just say about comps? And you think at this point which quarters are going to show a decline in earnings? If you're talking about a deceleration in growth, or are you actually calling which quarter will we see year-over-year earnings down from last year?
Well, we have an expectation where
first quarter.
If you have first quarter
down, how much?
Down a little bit. I think around 1%, something like that.
Okay. I'll see whether you're right about that.
So, and what about Conference Board says the same thing.
Well, I saw the Conference Board. What about second quarter?
Yeah, the point that I was making.
I don't think most analysts see a decline in year-over-year earnings in the first and second quarter. I still don't. They may be flat, maybe up 1%, 2%, 3%. It could happen. That would be something to keep your eye on. I think the point that I was making is if you look at Q4. Is that what you're forecasting?
So actual Q4 earnings were down almost 3 to 4% quarter over quarter from Q3. So you have a step down.
That's sequential.
Yeah.
Okay.
And then
that's sequential. Are you calling for year-over-year declines in earnings?
For this year, no. So we have a.
Well, I don't know what you're saying there.
Joe, one of the things I think that we're missing here is that one of the most underappreciated risks is China's stimulus has been going on since June of 2018. And right now it's starting to gain traction. And I would argue that China's starting to form a bumpy bottom. That's going to be good for global growth going forward. It doesn't mean that it accelerates. It just means that it stops going down. It could go up a little bit. And I think that's the accelerant. That's the fuel for the next couple of quarters going forward. Now, I'm not an equity guy. I'm not going to make an earnings forecast. But what I am going to say, though, is that it's an underappreciated risk to the extent that where is the surprise to the upside? That's where I think it's going to stem from.